Traders, Gary Wagner here, approximately 12 noon in Honolulu, Hawaii, second day of September, Friday, and this is the daily report for gold, our weekend review. Gold, after trading fairly sideways for the better part of a week, showed one of the greatest gains when we look at price action over the last month. U.S. unemployment data was reported as stagnant. In other words, the employment rate remained at 9.1% and payrolls were unchanged. Had a big impetus in the market. But as I will talk about in today's report, my belief is that there's something much more serious brewing that should affect the markets over the next couple of weeks. We'll talk about that here on today's daily report. Of course, we had gold trading up between $40 and $50 higher. In the December contract of COMEX, gained about 47.80, up about 2.6%, closing at 1876.90. And that, of course, was in New York. We have our cash market at 1882.32. And we have an incredible breakout that we witnessed, which began in overseas trading last night. As we do on all of our weekly reviews, I want to cover three basic topics today. The first of which is a synopsis of what we looked at last week, the trading activity of this current week. Secondly, is any trades that we implemented and the results of those trades. And then thirdly, my outlook for this upcoming week or interim term future. Now, the first thing that I want to say is I was under the assumption that as this market came down, and this of course is our A wave, that our B wave should be anywhere between 50%, which is 1806, and 1857, call it 1860, which would be the 75% target. And so that when we were looking through this market last week, let me draw that band in, my question was, as this market went up and we saw that correction that took us down to this 38 point right here, my question was, could we possibly construe that as a termination of B and C? My sentiment was, if it is C, it's probably the shortest C in history. We're probably most likely still in B. The market did come up, and then it began to trade sideways. My sentiment was, as you know, we have been in a waiting pattern all week. We didn't enter a short position. I would highly recommend staying away from any kind of a short position in this market. But we didn't enter a long position either. We were flat in the market. And for that, we absolutely left money on the table. There can be no mistake about that. However, at the same time, we didn't take on any position which caused a drain or a drawdown in equity. That being said, though, I must tell you that in straightforward Elliott wave terms, there is a market pattern which R.N. Elliott wave called a irregular correction or regular market top. That is one in which the marketplace itself, you would have a standard A, but rather than B going to 50 to 75%, it goes above this or it even exceeds the fifth wave. It's a regular top. My position is that the assumptions we made based upon Elliott wave were absolutely wrong, because this market did in fact trade lower, it traded sideways. But my belief is that the point in which it broke above our particular mark, this would be 1857, that all cards were off the table. In other words, whether it turns out to be an irregular top, however this market pans out, the underlying assumption that I was working with did not pan out. There can be no mistake about that. This market, once again, is an absolute runaway train. My belief is that, and I spoke about it all week, is that the fundamentals have done nothing but actually increase. They've gotten stronger, and so any kind of correction that we do experience is going to be short-lived. Now, can I with any kind of certainty tell you that, okay, we got our A, B, and this activity here would be a C, and now we're back into an impulse phase? I think it's much too early to put any kind of indication on that. However, what I will say is as follows. I am looking to, again, aside from some major change in fundamental news, we've got to be positioned on the long side of this market. We need to buy the dips as well as buy the breakouts. Traders, we are currently looking at a weekly chart, straight candlestick format. It has an Andrews pitchfork and channel lines in there. And we spoke about this week, but now that the week has come to a conclusion, we can add a little bit more. And that is this incredible drawdown week we saw, in which we saw a brand new high, 1913, I believe. And during that same week, we saw a low touch just at 1700. This rickshaw man. The interesting thing about it is the fact that the low came to the uppermost bottom of this upper channel. It actually found support. It is therefore my belief at this point that this market, as it continues to trade, has moved up, so to speak, an octave. It's a game changer in that I believe that any kind of a channel that we will see will now be composed of this former resistance area now becoming support. And I think that that's very, very critical, because what we get with that is, simply put, we will now have a new channel line. That channel line will be drawn off of the highs that we saw. And as I said, because of that, I think that rather than this old area, this particular upper band being a resistance band, I believe it is now become support. Traders, at the beginning of the show, I talked about a game changer. On a technical basis, and this is picking up from last week's review, what we noticed last week that I felt was as important as the new top that we made when we hit this 1916, what I thought was more significant was the fact that coming down $200, it found support at the former resistance end of the channel. Resistance has now become support. The ceiling is now become the floor. And what that means in terms of my outlook for next week, next month, and next year is as follows. My fundamental bias on the bullish side has not changed. If it's changed at all, it's simply strengthened. I believe more than ever that gold is going to be a stellar performer in the marketplace over the next 6 months to 1 year. The game changer is that the time frame in which I believe the market would hit certain target points has greatly accelerated. We've moved up an octave. So traders, based on this new information, the fact that we've really accelerated the pace in which the market is moving, my projections in terms of timetables have changed. And let me show you what I mean by that. These are the upper levels that I'm looking at because they're based upon the market trading near the upper band. What I'm simply doing is carrying this over and then moving it forward, so that in terms of December, I believe that we could see gold get close to $2,100 per ounce towards the end of this year. And I believe that by March 2012, we will be looking at $2,100 gold. Now, this target and objective, of course, will be adjusted as the market trades over the next 6 to 8 months. But traders, these last couple of weeks have been absolute game changers, because the fundamental factors driving this market have done nothing but accelerated. They have become an issue that is not being resolved and is worsening. Based upon that assumption, gold has nowhere to go but up. Where my projection right now stands at 2,100 by March of 2012. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you after the holidays for our next daily review. And if we get activity on Sunday and Monday here in the mainland, I will issue special signals derived by email. Have a great weekend. Bye-bye.
Many sights to see and when I look in my window. So many different people to be, that it's strange